My name is Harold Fetter. I'm a partner at BrazeauSeller, and I'd like to introduce my colleague Colin Green, who will be up here on the podium in a few moments. So the way we're going to work this, we'll each chat for about 15 to 20 minutes, and then we'll have time for questions at the end and hopefully get you on your way back to work, or if you have a better place to go, within about an hour. So thank you, welcome, and we will get started. So we have the agenda up there. We're going to start with an overview of the U.S. estate tax system. Then I'll talk a little bit about some inter vivos planning and things that you can do during your lifetime, and then I'll turn the mic over to Colin, who will then talk about some testamentary planning options, and he'll conclude with a bit of a potpourri of things that are out there and highlight the changing landscape that we're facing. Key questions that we're going to hope to address here today. First off, am I at risk, or are the beneficiaries of my estate at risk? Secondly, what is the nature of that risk? And thirdly, and perhaps most importantly, what can be done to try and mitigate that risk, whether during your lifetime or through testamentary planning? As we talk about this, both Colin and I think you need to keep in mind the concept of nexus. What is the nexus to the United States, and how does that affect my risk and the things that I can do to mitigate that risk? I'm going to start off with a quote. Better at reading quotes than I am at telling jokes, so we'll go with the quote from no less than Benjamin Franklin. Very famous quote: "In this world, nothing can be said to be as certain as death and taxes." And estate taxes are really the convergence of those two certainties. We know we're going to face them, so we've got to try and plan for them. So in Canada, just to highlight that convergence of death and taxes, we don't really have an estate tax system. What we have, and many of you may be familiar with the concept of a deemed disposition on death. So when a person dies, they are deemed to have disposed of all their capital assets at their fair market value, and you pay the capital gains tax as if that property was sold. So we don't have an estate tax. We have probate fees in certain provinces. Ontario would be one of them, but that's a 1.5% tax, not really an estate tax the way we have in the U.S. system. So let's talk a little bit about the United States and what we have there. And what we have there really is complication. I'll give you another quote. You may have a hard time reading it, but I'll read it out to you. "When a law becomes so impossible to understand that the ordinary citizen must look to the super expert, the law becomes a trap and not a viable guideline. For years, the income tax and gift and estate tax laws have been modified and amended to the degree that only tax lawyers and accountants could really make any sense out of them. Now, not even the tax lawyers and accountants are so sure of themselves." Robert Taft, and take a look at the year 1976. So 36 years ago, this was identified as a complicated system, and it's got nothing but worse since. So let's try and shed some light on this complicated system. By way of synopsis, just 4 quick points. First off, the estate tax in the United States is a tax on the taxable estate of a deceased person. And regardless of how that taxable estate gets passed on through trusts, whatever, there is an estate tax. Second point, the estate tax in the United States is part of the unified gift and estate tax system. So it works in conjunction with the gift tax to ensure that there is, at the end of the day, a taxable estate to be taxed. So the gift tax imposes tax on inter vivos transfers, and the estate tax obviously imposes tax when a person passes away, and they work in tandem, as I said, to make sure that there is a taxable estate at the end of the day. Just to highlight, for the gift tax, you're allowed $13,000 per year to persons generally, and $139,000 per year to a spouse in inter vivos gifting before you eat into the lifetime exemptions, which I'll talk about in a moment. So you have the opportunity within those thresholds to gift on an annual basis. Third point to note by way of synopsis is that the estate tax is a federal tax, and states themselves may impose additional taxes as well. And the last point And you'll hear about this throughout our comments, both mine and Colin's. This system has been in a constant state of flux, and we're, as you will see in a few moments, at the cusp of further flux, and the future is somewhat unclear. Okay, so what is the estate tax system? I'm going to go over some of the basics. So to start off, the system is a combination of graduated tax rates and exemptions that work together to create an effective tax rate. So in 2012, as we stand here today, we have a $5 million lifetime exemption for the estate tax, and we have a maximum tax rate of 35%. So individuals have a $5 million exemption, and at the highest end, we have a 35% rate of tax. However, as of 2013, as it stands now, the exemption is going to drop to $1 million, and the maximum rate of tax is going to go up to 55%. So if nothing changes between now and Jan 1, 2013, we've got a drop from $5 million to $1 million in the exemption, and an increase in the tax rate from 35 to 55% at the maximum rate. As far as what's going to actually happen out there, we really have no clue. So it was back in December 2010, we got the legislation to cover 2010, 2011, and 2012, which gave us the $5 million and the 35%. In 2011, there were 8 attempts at bills to try and get this passed going forward, unsuccessfully. Obama has suggested a $3.5 million exemption and a top rate of 45%. That's been rejected. Republicans want to get rid of it. Democrats want more. We really do not know where this is going to end up. So in terms of planners and people who were potentially facing liability, I think that you need to plan as if we're going to be faced with the $1 million exemption and the increased rate of tax. So that's what we're going to expect. It may change, but we simply do not know. And as I said, prudence would suggest that we need to face that in our planning. So in terms of the tax, who does it apply to? Well, the first 3 are people with, and I talked about nexus at the beginning, people with a personal nexus to the United States. So we've got U.S. citizens, we've got permanent residents of the United States, and we've got green card holders. Those people would clearly all be caught by the U.S. estate tax net. The last one, which is most important for Canadians, is that the U.S. estate tax applies to anyone with U.S. situs property, and we'll talk a little bit about what that means in a few moments. So that's going to be our focus, is the U.S. situs property and the fact that it does apply to Canadians. So in terms of what assets are exposed, if you have that personal nexus to the United States, and that incidentally could be a seminar unto itself in terms of how you get that personal nexus to the United States. But if you have that, then all of your assets are exposed to the U.S. estate tax system. So if you're not a U.S. citizen, resident, or green card holder, then you're only caught to the extent that you own U.S. situs property. So that obviously begs the question, what is U.S. situs property? The short answer is just about anything that is in the United States. The long answer, and I've provided a list up on the slide, but most importantly, the ones that we typically see are U.S. real estate and U.S.-based stocks and bonds. An exclusion, because we get asked this all the time, if you are a Canadian stock that's on a U.S. exchange, it would not be considered U.S. situs assets. But many of those items are, and essentially it's anything sourced in the United States. So we've established how you get caught. We've established the types of assets that may be caught. What type of credits can we claim in order to mitigate the damage? As I mentioned earlier, U.S. citizens or residents currently enjoy a $5 million exemption. That exemption is going to be dropping, as I said, in 2013 to $1 million. Under U.S. law, non-residents get a $60,000 credit. So that essentially shields $60,000 worth of U.S. situs assets for non-residents. The value of that would be about $13,000. But as Canadians, we get special treatment under the Canada-U.S. tax treaty. And essentially what that does for us is it entitles us as Canadians to the same exemption, $5 million in 2012 going down to $1 million in 2013, but prorated, and I'll get to a calculation in a few moments that will demonstrate how that calculation works. Therefore, as a Canadian resident, if you have less than $5 million of worldwide assets, or if you have less than $60,000 of U.S. situs property, you will not be caught. Now, as I mentioned earlier, the gift tax and the U.S. estate tax work in tandem. So if you've been gifting during your lifetime, that could eat away at the exemption. If you go above the threshold, and just as a reminder, it's $139,000 per year between spouses and $13,000 a year for others. So if you go above that in any year, it will eat away at the lifetime exemption. Let's take a look at an example just to demonstrate how the calculation works in terms of the prorated exemption, and give you some numbers, something that you can seize onto in terms of the impact. So we've got Mr. X, Canadian resident and citizen, who owns a U.S. condo worth $1.25 million and non-U.S. assets worth $5 million. So we've got a global estate worth $6.25 million. So the initial U.S. estate tax, based on the $1.25 million worth of U.S. situs property, is $418,300. We take the prorated credit, which is the $1.25 million. That's the value of the U.S. situs assets. That's the numerator. Over $6.25 million, which is the total of the global assets. And we apply that to the tax credit value of the $5 million credit, which is just over $1.7 million. And we get a prorated credit of $346,000 and a little bit of change. We deduct that from our initial U.S. estate tax calculation. We're left with an estate tax of $72,000 and a little bit more, which gives an effective rate of 5.7%. Not too drastic. That calculation applies if Mr. X dies in 2012. Take the exact same fact situation, have Mr. X die in 2013, and we can run through the numbers again, and our prorated credit has now dropped to $69,160 because our exemption has dropped to $1 million. And we now have, with the same fact situation, over 5 times as much estate tax payable of $379,140 for an effective tax rate of 30.3%. So just the change in legislation, exact same fact situation, and we've got, as I said, a 500% increase in the tax owing. Just by way of highlighting filing issues, even if we're under the exemption, so even if we're under the $5 million exemption in 2012 and the $1 million in 2013. If you have over $60,000 of U.S. situs assets, you do have an obligation to file on the passing of the individual holding the U.S. estate tax, the U.S. situs assets. Sorry. So. In 2013, if you're a Canadian, you have over $1 million of worldwide assets, and you have U.S. situs assets of at least $60,000, you may, in fact, have a problem. How do we address that? So I'm going to talk a little bit about inter vivos planning and things that can be done, and then Colin will pick it up with the testamentary planning. So in the past, the flavor of the month, and this was the flavor of the month for many years, was the single purpose corporation. You acquired the property in a Canadian corporation. That converted essentially the U.S. situs asset, which was the underlying real estate, into a non-U.S. situs asset because you were basically, your asset was the shares of the Canadian Corp. Well, as of 2004, the administrative position of the CRA changed, and they began to assess shareholder benefits based on that structure because you're holding a personal use property. So, no longer the flavor of the month. Existing structures prior to 2004 are grandfathered, but we needed to come up with another solution, because when you combine the shareholder benefit, the U.S. deemed disposition tax, and the U.S. taxes, it really was not a very tax-effective structure. So we needed to come up with other assets now, and other ways to hold the assets. Now, it's important to note that we're talking about real property here with the with the Canadian corporation to hold the U.S. real estate. If you're talking about investment assets, you don't have the personal use, then the investment holding corporation can be an effective strategy. It needs to be looked at, but it does not work with the U.S. real estate. So the next thing we'll look at is perhaps direct ownership. And if you're under the thresholds that I've mentioned earlier, direct ownership can be fine. If you're over it, it can be problematic. There has been the use of non-recourse mortgages, because if it's a non-recourse mortgage, the estate tax is calculated net of the mortgage, so that would reduce the value for the purposes of the U.S. estate tax calculation. However, as we all know, the lending situation in the United States has changed drastically, and the ability to obtain non-recourse mortgages may be severely curtailed and just may not be a viable option. Now, if we're talking about direct ownership, one structure to avoid is jointly owned property. In Canada, we talk about it because it avoids probate, and real estate is often jointly owned. In the United States, it's problematic from a U.S. estate tax perspective. The IRS will treat the jointly owned property as being wholly owned by each of the joint owners and effectively tax it twice from an estate tax standpoint. So, first to die, they tax it on the whole value, and if it's held by the survivor on their death, they would tax it in the survivor's hands as well. So you get that bad four-letter word, double taxation, if that was your structure. Now, if you're in that structure, you can use the gifting rules and gift up to $139,000 between spouses to effectively convert it over time into a 50-50 tenancy in common structure. So that would be something to look at if you're aware of somebody, a client or yourself, with jointly owned U.S. situs assets. The last solution that we're going to talk about is a specialized trust, a trust created in order to hold the U.S. real estate. The advantage of this is that on death, the trust does not trigger U.S. estate tax. However, there are some very important rules to keep in mind when you're using that structure. The one spouse with the money capitalizes the trust, and it's the other spouse who becomes the trustee and a beneficiary, potentially along with the children. But the capitalizing spouse cannot be involved in any way as a trustee or beneficiary. And because of that restriction, you've got to be careful about things like writing checks, who's involved in the management. If it is seen that the capitalizing spouse is involved in the management, that could taint the trust for the purposes of U.S. estate tax. So it is an effective structure from a U.S. estate tax planning standpoint. However, it comes with significant limitations. In our experience, it's probably about 50-50. That when people are faced with a U.S. estate tax issue on the acquisition of a U.S. property, about half of them say they're going to go with the trust, and the other half say, I'll take my chances. I don't want the restriction, in the sense the person with the money is using the property at the pleasure of the other spouse, and on that other spouse's death, if they die first, they have to start paying rent essentially to the trust for the pleasure of staying at the vacation property. So many opt out of it. But that said, it is a effective vehicle from a U.S. estate tax planning standpoint. With that, I'd now like to call up my associate Colin Green, who will examine some testamentary planning solutions. Thank you.
Wonderful. I'm just going to flip through. I think there's just 2 more slides. This is just a brief diagram of what Harold was just taking us through. Basically a diagram here showing that obviously spouse X would capitalize the trust. Spouse Y, of course, would be the trustee and the beneficiary, and then below we have our high production Arctic Cal value showing you the happily owned property safe from the potential application of U.S. estate tax and the reach of the IRS. As Harold indicated, the benefit of the structure is that the trust will be shielded from the potential application of U.S. estate tax. That's the primary goal that we're trying to achieve when we're working within a U.S. context. However, as you noted, the contributing spouse cannot be a beneficiary. This is really the key restriction, which is why if we're going to do this, it's the kind of structure that has to be properly explained and properly established and set up. This isn't something that people can kind of split the difference and they pull the money out of a joint account and then there's a trust, but no one really worries about it. This is the kind of structure that needs to be very precisely structured and run on a yearly, annual basis to make sure that the protection that has been established is maintained. As we note on the slide, after the death of the non-contributing spouse, the surviving spouse would have to pay a reasonable rental rate as well. So, having outlined the risk of U.S. estate tax and considered some possible inter vivos steps that can be taken to mitigate that risk, as we can see, the question is, well, what next? We can avoid U.S. estate tax insofar as possible during the lifetime of a potential taxpayer, but frequently our clients want more. They want to know what can we do with respect to passing on their inherent wealth to the next generation, and the answer, of course, is testamentary planning. When planning for U.S. residents, or possible U.S. residents, individual taxpayers, spouses, children, grandchildren, we use 2 fundamental building blocks. We use the Q-Dot trust, and we utilize ascertainable standards to make sure that we can put structures that are as tax efficient as possible from a U.S. estate tax perspective, and I would note in a Canadian tax perspective as well. Let's talk about the Q-Dot for a couple brief seconds. If the surviving spouse is a U.S. citizen, the estate of the decedent spouse enjoys full marital deductions. By this, it's meant is that there'll be a degree of coverage from U.S. estate tax. However, if the surviving spouse is not a U.S. citizen, there's no spousal rollover treatment similar to what we have in Canadian law, with the exception of a qualified domestic trust, a Q-Dot. This enables us to realize the marital deduction, and I'm going to get to some diagrams that are going to walk us through exactly why this is very important. There are several administrative requirements. Again, the U.S., perhaps even more so than the CRA, are fairly particular about ensuring that certain requirements are met, so it's very important that we observe these requirements when we're looking to establish them. The trust is created by the deceased spouse, must otherwise qualify for the marital deduction, so this means we have to ensure that all income goes to that spouse for life, and then at least one trustee must be an individual U.S. citizen or domestic corporation. Further, no distribution other than income may be made from a trust unless the U.S. trustee has the right to withhold estate tax that would otherwise have been imposed. Now, the election for the Q-Dot is made on the death of the first spouse. Thus, it's not something that clients have to rope themselves into when they set up their wills, but it's more that they would need to have the appropriate planning in place so that the option is there at the time of death. The trust must meet the other requirements to ensure the collection of any necessary tax. The executor of the deceased spouse must make the irrevocable election, as we've just discussed, to treat the spouse, the trust, my apologies, as a Q-Dot, and estate tax is due when capital is distributed to the surviving spouse on his or her death. So what we're seeing here is that this is a deferral mechanism designed to extend the deferral to enable the surviving spouse to have the benefit of the assets without having U.S. estate tax apply. We can basically put it off for as long as possible, and then we can take advantage of the joint credits of both of them when the surviving spouse is deceased. Let's talk a little bit about the use of ascertainable standards. Now, in some literature, people will refer to this as a bypass trust. Otherwise, you can refer to it as ascertainable standards. For clarity today, I'll refer to it as a bypass trust just because it's less of a mouthful, but just so we're all on the same page. A bypass trust can be a spousal trust for Canadian tax purposes. If descendants are not included, from a U.S. perspective, the descendants can be included. The spouse and beneficiaries can be trustees, but they can only make distributions for health, education, maintenance, and support. Fair question would be to ask what exactly constitutes those categories, but it's a pretty broad category from our research. In short, basically, you can utilize this trust to support your lifestyle for health, education, maintenance, basically living in the style to which you are accustomed. But the point is, by having a arguable set of independent standards, we can create a body, a legal body, a construct that will be separate for U.S. estate tax calculations and prevent the assets of the trust from being captured by U.S. estate tax. An independent trustee, again, ideally a non-family member, but at a minimum a beneficiary under the trust, can make distributions to the beneficiary for any reason. So typically for flexibility, we would provide for an independent trustee to be appointed, and a 5% withdrawal power on one day each year, so as not to be included in U.S. estate tax, is permissible as well. So if we put it all together, we'll consider the following two and a half scenarios. We'll look at a Canadian citizen / resident spouses with U.S. property, so neither of them are U.S. citizens nor residents, and we'll look at married couples, one U.S. citizen, one Canadian resident, where the U.S. spouse dies first, in addition, the Canadian spouse dies first. For those of you who know tax lawyers, you'll know that structures and diagrams are always the high part of anyone's presentation. So here we have the married couple, both Canadian resident citizens, and they're holding U.S. property. So we're basically asking the question, what happens on the death of that first spouse? Well, as we can see in the middle, if we're utilizing a spousal trust for non-U.S. property, we're not really worried. We can achieve a spousal rollover to achieve the deferral that would otherwise result on the death of that spouse, and that settles our problem for the non-U.S. property. So now we have to deal with the remaining U.S. property of the estate. Harold showed us some numbers before, and so we've learned that as of 2013, that could be quite a substantial number that we're having to wrestle with. So there's two scenarios. In the event that the U.S. property is greater than the prorated exemption, absent the utilization of a Q-dot trust, U.S. estate tax would apply right away. And this would obviously be an issue because spouses have their joint assets, they have their lifestyles, and they're really wanting to defer that U.S. estate tax as long as possible. Frequently, it's difficult for a spouse to sell half the assets in terms of realizing their continued use of them. So to get around this issue, we utilize a Q-dot or a spousal trust. And if this is utilized, and what this does is it will defer any possible estate tax until after the death of the second spouse. So no wizardry. Any U.S. estate tax liability that needs to be paid will be addressed, but it will only be addressed on the death of the second spouse. Further, I would note that doing this will ensure that you match your credits up in terms of using your qualified credits on the U.S. side, the prorated version that Harold talked about, in addition to Canadian credits when you're dealing with the death liability, the death tax liability. Okay, let's talk about the scenario on the right hand. U.S. estate tax is paid in those. Well, this scenario is what happens if U.S. property is smaller than the prorated portion of the exemption. In such an instance, you would quote-unquote pay or deal with the U.S. estate tax liability, which is nil. But then we don't want to take all those assets and put them back into the surviving spouse's names, or we're setting ourselves up to have a double U.S. estate tax issue. But we still want the spouse to be able to utilize those assets. This is why we utilize a bypass trust. As we've just discussed, if the trust is set up with all the correct standards and it provides for the continued use for health, maintenance, education, essentially lifestyle of that trust, that spouse can utilize the bypass trust to continue to fund their lifestyle without having those assets be exposed to additional U.S. estate tax. So basically, it keeps it in a pool that is separate from that second spouse's, the surviving spouse's assets, to assure those assets are not taxed. Okay, next scenario. Married couple, one U.S. citizen, one Canadian resident citizen, and the U.S. spouse dies first. On the death of the U.S. spouse, if the assets are smaller than the exemption, and I'm on the left side of the diagram up here, what would occur is that we would utilize a bypass trust, again, to defer the payment of U.S. estate taxes insofar as possible, and then ensuring that there's no U.S. estate tax on the death of the second spouse. On the flip side, in the event that assets are larger than the exemption amount, we would utilize a Q-dot or spousal trust and deal with any encumbrant U.S. estate tax liability on the death of the surviving second spouse. Same scenario as before, and we utilize these pieces to ensure that we can either A, defer the U.S. estate tax insofar as possible, or B, eliminate it altogether by dealing with the spouse's assets and then preventing any possible spillover. Basically, if a spouse dies and their assets don't subject them to U.S. estate tax, sometimes they're right at the threshold. If we pass the entirety of those assets to the surviving spouse, we're creating a big tax problem for them. And so that's what this structure is designed to do, to ensure that we keep their assets separate and apart to avoid any potential tax issue. Second scenario, a little more streamlined. One U.S. citizen, one Canadian resident citizen, and the Canadian spouse dies first. In the event that the Canadian spouse dies first, all U.S. estate tax can be paid, and then we would utilize a bypass trust insofar as possible to keep those assets into a separate pool. So on the death of the U.S. spouse, whose assets obviously would be everything is cited as property for U.S. estate tax calculations for the U.S. trust, for the U.S. spouse, will prevent the possible application of estate tax to the assets of the bypass trust. So again, the idea is this is to keep the estate clean insofar as possible from assets that have already been through a probate type of process. A couple brief notes about other things that are out there. In doing reading, especially if you're reading stuff that has led up to the current event for U.S. estate tax, there'll be a lot of chatter about dynasty trusts. These are used to basically pass assets to the future. There's a lot of literature out there about how the Kennedys did some really interesting things where they basically took large chunks of assets, and some of the oil barons in the U.S. too, and they would skip it. It's like a rock skipping across a stone. So they would have assets leapfrogging into various generations over a 20 and 30 year period, and thus ensuring that not every generation had the full use of assets, and not every generation was fully exposed to U.S. estate tax. It's an interesting concept, except for a couple drawbacks. One, you need to have tens, if not hundreds of millions of dollars. And two, as we'll see at the bottom, Congress has enacted the generation skipping transfer tax for precisely this purpose. So, but for a $5 million exemption that remains until 2013. So we're not really suggesting that this plan is generally something that needs to be utilized. It's more that I want the people here today, I want everyone to know that this is why it was out there, and this is why it's no longer being used. So if someone's talking to you about it, you're aware of why we've kind of backed off the concept. Beyond shifting exemption limits and tax rates, increased risk from new government policies. And this is more just that we're seeing this shift in U.S. estate tax, where it's dropping to $1 million in 2013, isn't an isolated incident. We're seeing increased pressure from the IRS and CRA with respect to wanting to ensure that they claim or acquire, for lack of a better word, their due recompense or their due percentage of taxpayer revenues. So on January 9, the IRS reopened its offshore voluntary disclosure program, which is similar to the Canadian experience with a few subtle differences, for U.S. taxpayers holding undisclosed foreign bank accounts. Two previous programs in 2009 and 2011 brought in $4.4 billion. So it's safe to say they've had some success with this model. They've opened it indefinitely, which is a strong shift with slightly harsher penalties. But basically the IRS is signaling that they're increasingly going after the assets of taxpayers, whether or not they're U.S. citizens, whether or not they are aware of their U.S. tax liabilities, in fact, whether or not they've even utilized any services as American citizens. So it's important to note that there's an increased level of risk out there from a U.S. perspective. Further, CRA, perhaps not wanting to be left out, has started a project targeting high net worth individuals with complex tax structures controlling several entities. The way this works is selected individuals, I always want to say lucky individuals,